Imagine a digital empire, a cryptocurrency exchange heralded as the industry's safe haven, promising security and innovation. Yet, beneath its shimmering facade, it was built entirely on a foundation of digital smoke, a house of mirrors reflecting a fabricated reality. This wasn't merely a market correction, it was a complex financial deception, a gambit that ensnared billions before its inevitable spectacular collapse. This is the story of FTX and the illusion that vanished. For a brief, dazzling period, FTX stood as a beacon in the volatile world of cryptocurrency. A perceived bastion of legitimacy, a global exchange that attracted the trust of millions, and the capital of some of the world's most sophisticated investors. But like a mirage in the desert, its solid appearance concealed a fragile, meticulously constructed illusion. Today, we deconstruct how this supposed safe haven became a catastrophic house of cards, revealing the financial engineering, the strategic misdirections, and the fatal flaws that led to its undoing. FTX's ascent was nothing short of meteoric. Founded by Sam Bankman-Fried, or SBF, it quickly carved out a significant niche, positioning itself as the adult in the room, within a notoriously unregulated and often chaotic crypto landscape. SBF, with his carefully cultivated image of an effective altruist and a future-forward visionary, successfully attracted enormous capital. Retail investors flocked to the platform, drawn by promises of security and innovation. Crucially, established venture capitalists and institutional funds, usually wary of crypto's Wild West, poured billions into FTX. Swayed by its seemingly legitimate operations and SBF's compelling narrative. The data streams of this era would show a torrent of funds, both retail and institutional, converging on FTX. This aggressive strategic marketing, coupled with the perception of a responsible leader, gave FTX an air of unshakable solidity, allowing it to rapidly expand its global footprint and influence. It appeared to be doing everything right, becoming a cornerstone of the burgeoning crypto economy. But beneath this veneer of legitimacy lay a sophisticated and ultimately catastrophic deception. The heart of this illusion was the intricate and highly problematic relationship between FTX and its sister company, Alameda Research, a crypto trading firm also founded by SBF. Alameda Research relied heavily on a digital asset known as FTT, FTX's own proprietary exchange token. Here's where the art of obfuscation truly began. Customer deposits, meant to be held securely on FTX, were quietly and strategically siphoned off-book to Alameda Research. These transferred funds were then used by Alameda for highly speculative, high-risk private investments. The crucial twist: Alameda's balance sheet was heavily propped up by vast holdings of FTT, the very token issued by FTX. As Alameda's risky investments leveraged more FTT, the perceived value of FTT would artificially inflate, creating a self-reinforcing but fundamentally unstable flywheel effect. This gave FTX the illusion of a robust balance sheet, seemingly overflowing with assets, even though many were illiquid and self-issued FTT tokens. The isometric data streams graphically illustrate this. Customer funds entering FTX then surreptitiously flowing to Alameda, only to return to FTX as inflated FTT value, cycling in a continuous artificial loop. This intricate web bypassed all conventional risk management protocols. Crucial tactical closed-door decisions were made to override basic financial safeguards, allowing customer assets to be treated as Alameda's venture capital, a fundamental breach of trust and financial prudence. This was a system designed to appear solvent, while systematically exposing customer funds to catastrophic risk. The House of Mirrors could not stand indefinitely. The critical turning point arrived when CoinDesk published a leaked balance sheet for Alameda Research, exposing its precarious financial position and its reliance on the self-issued FTT token. The revelation sent shockwaves through the crypto community. Then came the strategic, fatal blow. A rival CEO, Changpeng Zhao of Binance, publicly announced his exchange would sell off its substantial holdings of FTT tokens. This wasn't merely a tweet, it was the spark that ignited the tinder. The market, already spooked by the leaked balance sheet, reacted immediately. An unstoppable algorithmic bank run commenced. Investors, sensing contagion and potential insolvency, rushed to withdraw their funds from FTX. The illusion of liquidity, so carefully constructed, vanished in a matter of days. The data streams, once so confidently flowing, now indicated a frantic, uncontrollable outflow, shattering the golden token's deceptive stability. The collapse was swift and brutal. Within days, FTX, once valued at an astronomical $32 billion, faced an $8 billion shortfall and filed for Chapter 11 bankruptcy. Millions of users found their assets frozen, potentially lost forever. The digital fragments of the shattered token symbolize the instant evaporation of wealth and trust. What followed was a cascade of criminal charges against SBF and other executives, alleging wire fraud, money laundering, and campaign finance violations. The supposed adult in the room was revealed to be orchestrating one of the largest financial frauds in history, built on a foundation of deception, misused customer funds, and a complete disregard for financial probity. The meticulous illusion had shattered, exposing the stark reality of fatal miscalculation and deliberate malfeasance. The FTX saga serves as a chilling testament to the dangers of blind faith in charismatic founders and the catastrophic failure of elite venture capital due diligence in the face of FOMO, the fear of missing out. Some of the world's most sophisticated institutional investors poured billions into a complex financial exchange that terrifyingly lacked even a basic functional accounting department. It's a stark reminder that even in the most innovative and rapidly evolving sectors, fundamental principles of transparency, risk management, and regulatory oversight remain paramount. When these are deliberately circumvented, even the most glittering promises can quickly dissolve into nothing but a pile of digital dust. Join us next time on the Boardroom Gambit as we delve into more high-stakes power plays and strategic downfalls. If this unraveling of the FTX illusion resonated with you, be sure to like this video, share it with your colleagues and friends, and subscribe to the Boardroom Gambit for more strategic insights into the plays that shape our world.